First of all, I want to get us let's get a copy on screen of the 10-year yield, just to show people over the past, say, 40 years just how low it's gone. Do we have that? There we go. And of course, you can see this is from 1962 up until 2012. You know, back in the early 80s, we got a 10-year yield up above 16%. Now we're down around 1.7%. In other words, you know, never mind inflation. People are just willing to give their money to Uncle Sam, pay huge prices for Treasury bonds, in turn driving yields down. And of course, Steve, one thing you've talked about is deleveraging. The reason people are so worried and they want to give their money to governments like the U.S. and then Japan, we just mentioned, is deleveraging. And tell us a little bit about that. And as you do, let's put this other chart of yours on screen.
Okay, I hope you're looking at it pretty shortly. The red line is the level of private debt compared to GDP. That's a combination of household debt, business debt, and the financial sector's debt. And if you take a look at it, I hope people are saying, holy hell, as they're looking at it, because you can see way back in 1945, the private debt rate was about 45% of GDP. And we now fast forward to the absolute peak of the bubble we've been through, and it reached 303% of GDP in early 2009. And now it's been paid down to about 250% of GDP. So over the last, the 60-year period from the end of the Second World War to the end of the great, so-called Great Moderation, we actually had an incredible increase in the level of private debt. Some of that money was used to finance decent stuff, investment, iPad development and stuff like that. A lot of it was gambling on house prices, wonky internet companies and all the other garbage we've gambled on in the stock market for the last 20 or 30 years. And it got to a stage where there's so much debt you couldn't persuade people to take on any more debt. And what you've gone is from a period where rising debt was accelerating and increasing demand to now a period where people are paying their debt down, and to do so they've got to spend less than they earn, so you've got aggregate demand being less than income.
The scary thing is, through the 80s, through the 90s, and through the 2000s, as we were lowering interest rates, right, as the Fed was encouraging more credit to flow into the economy to boost spending, basically we blew up credit in the economy, so total debt, private and public, reached something like 400% to GDP.
Yep.
And now private debt's coming down, but public debt's just replacing it. And we still have all of this debt in the economy. And Steve, I guess my question really is, how do we really can't, how do we deal with it? Do we wipe it away? I mean, because basically your point is the economy can't continue to grow until we've dealt with deleveraging.
That's right, because if you try to deal with it just by running large deficits, and that's better than running surpluses right now, by the way, but if you run large deficits, you're trying to boost the economy by the government increasing its spending more than it brings in with tax revenue, but at the same time the private sector's spending less, substantially less, and money's being sucked out of the economy. And if you let it go through the natural process by which this sort of stuff happens, and like we saw back in the Great Depression, that could take 15 years. And America hasn't got 15 years of depressed economic conditions.
Of course, you've got, Steve, you've got a fairly radical solution that you would advocate. Basically, we talk about Helicopter Ben and Ben Bernanke. We don't want to print money the way we have been and effectively giving it to banks. You would probably advocate an actual helicopter drop, more or less, giving money directly to people.
Yeah, I think we need quantitative easing for the public, not because you actually want to print money, inverted commas, the usual, what's seen as a Keynesian way out. It's not at all Keynes, so that's what people call it. But because we want to reduce debt and reduce it rapidly, and there's far too much debt-based money out there that should never have been created in the first place. So you need to get rid of it. But if you try to get rid of it in the old-fashioned sense of abolishing debt, you'd actually send bankrupt people who quite innocently bought bonds off the banks that they thought were valid instruments. And of course, they find they're toxic as well. So my idea is give the money to the public, but require the public to pay their debt down first and foremost. It's not there to spend, it's there to reduce your debt level. Now, if you don't have any debt, you do get a cash bonus. And the benefit of that would be that people who would lose out by, saying they were being morally sensible and didn't get into debt, why they should suffer. They wouldn't suffer through this, they get a benefit out of it. The main impact would be reducing the size of the financial sector and eliminating the debt rapidly, rather than going through the slow grinding downturn we'd face if we let people go through the usual course of individual bankruptcy.